OK，这里已经好了，我这边，所以 YouTube 已经看了，那个 Facebook 是要等到准时才可以做。凯用，你现在开始 play 那个backdrop 跟那个 BNG 的声音啊。OK，这里已经好了，我这边，所以 YouTube 已经看了，那个 Facebook 是要等到准时才可以做。凯用，你现在开始 play 那个backdrop 跟那个 BNG 的声音啊。OK，这里已经好了，我这边，所以 YouTube 已经看了，那个 Facebook 是要等到准时才可以做。
All right. Okay. Good evening, everyone. Welcome to today's live stream. My name is Kayong. So very honored to have this opportunity to be sharing with you guys today. And of course, thanks to KVB for inviting me and giving me this opportunity to reach out to more traders and of course share with you guys my experience as well as of course some of the trading insights with you guys. Okay. So I'm aware that today's stream is actually concurrently broadcasted to two platforms, right? One is on YouTube and then one is on Facebook. And obviously there are like chat features on the platforms itself. Yeah, so feel free to interact and as we progress, sometimes you might have questions and things like that. Do feel free to put it into the chat box as well, right? So over here on YouTube, I do see Hun Hun is here if I pronounce your name correctly. Um, I also see Alex, right? Saying that thank you for organizing this webinar as well as YG Tan here as well saying hello, right? So yeah, great to have you guys joining in. And today's topic over here, as you can see on the screen, will be sharing with you the framework core DSC, right? And this is basically a personal trading framework that I use to give me a while. All right, let me just turn this on. Okay, let me just turn on my webcam. Give me a little while. All right, okay. Should be good. Is this okay? Good. Okay, so yep. Yeah, I was saying that, feel free to use the chat and then today's framework will be DSC. Okay, so this is basically a technique that I've been using for many years. And I would say, after we share with you this framework, hopefully the objective for today's session is to give you guys the clarity to approach the market, right? So it doesn't matter what strategy you use, what techniques you use. This framework is essentially a universal framework that you can apply in your trading. Okay. So with that said, let me very quickly share a little bit about the rewards and some of the promotion that you can actually get from KVB over here. Of course, if you're very new to KVB, do feel free to click on the link in the comment section. Right, so if you're watching on YouTube, it's on the chat. If you're watching on Facebook, it's on the comment section. Do click on the link where you can actually find out a little bit more. You can actually register. So for your own individual account. If you have any questions, of course, feel free to reach out directly to them. But what I want to share with you very quickly is a very unique promotion that KBB is currently running, right? It's called the switch bonus, right? So this is basically I've logged in to the account, right? You can actually register and then after that you can log in. And then you go under the rewards tab over here on the left. That's where you can see the promotion, right? And this is pretty unique where you can see there's this thing called the switch bonus, right? It's basically valid until the end of this year as of now, right? So if you click onto this here, you can actually understand a little bit more about this. But what I find it very unique is essentially if today you have like, other platforms, other accounts, and today you would like to try it out, right? KVB, you can actually benefit from the promotion that they're running as well, right? Which basically you can submit your application. Um, After opening an account, you can make a deposit, right? And you can actually claim your bonus, which is 1% switch reward bonus based on your total deposit, and there's a cap of up to $2,000. Okay. And of course, you can understand a little bit more about the details on this here in terms of like, double bonus. You have the 1% as well as the cashback, right? So for those of you interested, as I mentioned, the link is in the chat, right? Feel free to click into that. Uh, and of course, register for your account. And if you have any questions, feel free to also reach out directly to KVB, right? So today's session over here, and just also give you guys a little bit of like into what we are gonna run for this month. Okay, every Tuesday for the month of November, we're gonna be hosting a live stream. So what I'm doing in today's live session over here is to share with you the framework first, right? To give you guys the foundation of how I approach the market. Naturally, I'll do a little bit of live analysis today as well. And then next week on Tuesday, what we'll be doing is more of like diving directly into the live market analysis. You have the opportunity to ask questions in terms of like, you know, what instruments you'd like me to perform and do an analysis and share insights with you. Next week's session, we'll dive straight into that, right? Today is more of covering the framework first so that next week, all of you who are watching the analysis would have a better understanding of, how I approach the market, right? What are the techniques that I'm using? Okay. So let's jump into the slides here. Okay. And as I mentioned, right, as we progress throughout, if you have questions, just put it into the chat, right? So I see Ram is here as well. Hello. Good. Okay, so let's get started, right? Let me cover what is the DSC framework, okay? And what does it kind of constitute inside, right? So as a trader, or some of you who have been perhaps trading for some time, okay, you would probably know that there are some elements you need to get it correct in order for you to make money, right? And one of it is obviously direction, right? You need to have a technique, you need to have a method to kind of forecast, or I would say pick a high probability side of the market, right? Whether is it going to go up, is it going to come down? Do you want to look for buy or do you want to look for sell trade? Or if the market is not clear, you just basically stay away from it, right? So you need to have a technique, you need to have the method to help you identify the high probability direction, right? And this is the first core element of a profitable trade, which is the direction, right? Which stands for element in the framework itself, right? And over here, just to very, very quickly cover, there are generally three categories of how we can identify the direction. Number one is we can through macro fundamentals, right? We can look into what the central banks are doing. We can look into the liquidity of the overall market, okay? Which I'm not going to cover in details for this category today in terms of like fundamentals. But of course, if you guys are very interested into that, do let KVB know. Okay, we can actually organize a topic on that as well. Then of course there's a technical aspect of identify direction, right? We can look into charts, we can look into indicators, we can look at patterns, and this is something that we'll focus on today. Okay, because for me, I focus a lot on technical analysis to help me identify the high probability direction. And to be more precise, what I'm using in terms of technical analysis would be based on Elliott wave principles to help us identify the direction. Okay, and today I'm going to cover that aspect with you guys as well. Okay, and of course you can see over here sentiment as well, right? So what is sentiment market analysis? Is basically understanding is the market in a risk on or risk off environment, right? So to put that, it's in a way to understand it, is the market in a kind of stable condition or is it in a uncertain environment where traders and investors are in a panic mode and things like that. So that would also dictate the direction of certain instruments and asset classes, right? So in short, you need to be clear what are the techniques and methods you're using to identify this high probability direction. Now, obviously, if you don't have, it's a very good time to actually pick it up. And today I'll be sharing with you one of the techniques. Okay. Now, if you have been trading sometime, you also would realize that, sometimes when you pick the right direction doesn't necessarily mean you're going to win, right? Because if you have experience, sometimes you enter a trade, you buy it, but price actually hit you in the stop, hit your stop loss and then only eventually hit higher, right? So you kind of got, oh, it hit my stop loss, I got out, and then the market eventually go in my direction. So then you realize that, all right, in a profitable trade, you cannot only pick the right direction, right? The right direction is obviously important, but you need also get into the trade at the right time. Okay, and of course, when I mean right time, it basically means your entry needs to be right, your exit needs to be right as well, right? And that element itself is what we talk about as setup, right? So setup encompasses your strategy, how you're gonna get in, get out, which price is it that you're gonna get in, which price are you gonna put your target or stop loss, right? So that's one. And when we talk about timing, it's also about sessions, right? Sessions over here, of course, if you're doing intraday, then you need to be aware in the FX environment, we have Asia market, we have London market, we have US market. Okay, so that itself can dictate how you're gonna trade, right? Are you trading at a prime session, okay, and things like that. And then, of course, if you dive a little bit deeper and go beyond the FX market, we have the idea of seasonality. So this is a bit more applicable to commodities market like gold, silver, crude oil, or even the stock market and indices market, right? Where we can then look into statistics and historical data to understand, generally which are the months or even days that a certain instrument tends to go up or go down. Okay, and we can then use that to time our trade in terms of entry and exit as well. Okay, so that is what we talk about setup, right? And today I'm going to share with you a setup based on the SMC Smart Money Concept model that I personally use to trade as well. Okay, so today, in the direction aspect, I'll share with you Elliott wave principles to help you determine that. Then in the setup component, I'll share with you the SMC model that you can use to actually engage and execute your trade. Okay. And then of course the last component in the DSC is basically what we call context. And context over here is also very important because it builds in what we call confluences. It builds in the multi-time frame alignment. It builds in your risk structure as well, right? So I'll give you an example of context is if today you're looking at 4 hour time frame as well as a high on the hourly time frame, then you have this multi-time frame alignment, right? If the higher time frame on H4 is bullish bias, but H1 here you're looking at a sell trade setup, then you're looking at a counter trend, right? If you're looking at a counter trend, then you need to be very clear. Are you looking at a retracement trade or are you looking at a trend reversal trade, right? So that will help you make a decision in terms of like what is your risk structure, right? Do you want to take a smaller risk? Do you want to go for extended take profit levels, or do you want to be more conservative in your take profit and things like that, right? So context basically put things into perspective to help you make decision in your trading, to help you make decision in your trade management. Okay, so it's a little bit more in terms of like the structuring of your risk, structuring of your target profit levels. Okay, so if you put all this together, then that's where you actually get a very complete framework to approach trading, right? You need to get the direction right, you need to get the timing right. Then you put all things together, that's where the context comes in, right? And if you apply this framework in your trading, that's where you start to gain clarity, okay? Because if today you realize that every time you put in a trade, your direction is always wrong, right? You buy and then the market just goes down. Then you realize that, all right, whatever techniques you use to project the direction is just not effective. You need to go and improve on that, okay? Then you realize if your journey of trading is every time you get involved in the trade, it hits your stop and then only it goes in your direction, then you know it's your timing, right? Your direction is fine, you get it, right? But it's the timing that needs improvement, okay? Or if you start to realize that, hey, every time I manage to win, but whenever I win very small, but when I'm wrong, I lose a lot, right? So maybe that's the element of context, right? Your risk structuring needs to be worked on. So this framework gives you that kind of roadmap to understand what are the areas that you need to work on in your trading to give you clarity so you know, okay, this works, keep on doing, this doesn't work, how can I improve on it, right? So that's the whole objective of it. Okay, so let's talk about technical analysis and using technical analysis in terms of like Elliott wave principles to help us identify the direction. Okay, and I want to break Elliott wave down into very practical and very simple understanding that after today's session, you can literally take this and start applying it in tomorrow's market. Okay. And when we talk about technical analysis, it's really all about patterns recognition. It's about price pattern, and you don't need a lot, right? You just need essentially two types of pattern. One is what we call a continuation pattern. Basically, when this pattern occurs, you know that there's a very high possibility the market will continue in its prior trend. And then we have the reversal pattern, right? Which basically means that if today you see a pattern like that, then be careful. The market might U-turn itself, okay, and then you want to look at and focus on the opposite direction, okay. So I give it a name here. Impulse correction is basically a continuation pattern. I'll show you in a while a visual look on what I mean by impulse correction. And then we have the reversal pattern, which I call it the impulse crawl. Okay. So let's take a look at the impulse correction. Okay. Now, very, very quickly, what I mean by impulse, right, is when the market is essentially developing a very fast and strong momentum move. That's what we call impulse, right? So if you take a look, this is an impulse leg. Okay. Um, and then if you take a look at the right hand side, okay, this came down pretty fast. That's also an impulse leg. Okay. So remember, impulse refers to strong momentum market movement. It doesn't matter what time frame, as long as the market is moving very fast with strong momentum, that's an impulse move. Okay. The opposite of an impulse is when the market is doing a corrective move, right? Which you can see over here. It comes down, it goes up, it comes down, it goes up, it comes down. Essentially, it's just very slow in its development. It's taking a relatively longer period of time to develop. There's really no clear sense of direction as to where the market is doing. It's kind of like in a range bound environment, right? Similarly, on the right, you can see, up, down, up, down, up, down, but it's really not very fast. Okay, so this type of move, we label them as correction. Okay, basically slow moving market environment. So same thing here, right? This pattern you can identify on any particular time frame, and we are basically doing a comparison of a fast development of price and a slow development of price, right? If it's fast, it's an impulse. If it's slow, it's a correction. Now, when we start to understand that and we put them into categories, right? So, meaning if today we see an impulse followed by a correction of a pullback, right? So the impulse is going up and then the market starts to pull back slowly as a corrective move. There is almost 70% probability the next move will be going higher. Okay, so that is where the pattern recognition comes in, and it starts to tell us where do we want to focus, what direction. Okay, on the opposite here, if we see market comes down very fast and then we see a slow little pullback, which is a correction, again, there is a 70% chance the next move will be going lower. Okay, so what this means is every time you open a chart, whatever time frame you're looking at, if you spot an impulse correction pattern combination, you have a clear directional bias. Okay? Meaning you know which is the direction that the market would likely move towards, and that's where you want to be focusing on, right? Obviously, if it's a bullish bias, you look for buy. If it's a bearish bias, you look for sell. Right? So that's the first pattern. Okay, so let me show you examples of how it looks like on the chart, right? Obviously, these are all completed pattern examples, but I just want you to learn from it first, right? Visually, I want you to get familiarized with how the pattern looks like. Okay, so you see here, right? We have the first fast impulse move up and then followed by a correction, which is a slow moving pullback. What happened next, right? The market actually went higher. Great, right? Which is what I'm telling you. The pattern tends to repeat itself, and there's a high probability that's going to be happening, right? Then you have correction again, and then the market continue higher. So this is where we start to identify, as I mentioned, right? Every time we see an impulse followed by correction, we can start to forecast with high confidence and probability that it's gonna be a continuation, right? When the market is coming down, it's the same thing, right? You see an impulse move, you see a correction, the market continue lower. forms a correction, it continues lower. It forms a correction, it continues lower. Okay. So this is what we call pattern recognition because it tends to repeat itself over and over in the market. It tends to carry what we call a reliability factor, which means very high probability when we see something like this, it's likely going to happen, right? So we can use this pattern to project and forecast what will happen next, okay? And that's how we establish our directional bias. Okay, so I'll very, very quickly give you guys a little bit of example and activity, right? Exercise here. Now, if you take a look at this particular pattern, right? The question is, which direction would you focus, right? Would your bias be bullish or would your bias be bearish, right? So if you take a look at this here, you always ask yourself the question, right? Do I see a clear pattern combination? Okay. Is there a clear impulse? Is there a clear correction? Right. Now, in this example, it's pretty straightforward, right? What you can see is this move up is pretty strong. That's what we call an impulse move. And then after that, the market comes down, up, down, up, down, up, down, up, down, very slow, right? And this pullback is what we call a corrective move. Okay. So in this combination, what we have is an impulse correction combination. And as we said, right, if today we have an impulse corrective combination, what is the direction we're expecting? Upside. Because there's a 70% probability that's what this pattern is telling us. Okay. And all we have to do is really look at this, identify a pattern, and say, all right, we have a 70% chance it's going up. Let's focus on being bullish bias. Let's focus on buy trade opportunities. Okay. And this is exactly what the market does. Okay. So at this point, with this kind of pattern recognition, when you're able to do that, you're able to very confidently tell yourself, right, whether you want to be looking at buy or looking at sell. And then, of course, then the next phase is where we're going to go into is more like where to buy, where to sell, right? That's the setup phase, right? But before you go into the setup phase, you need to first identify is the market going up or going down, right? Before you can make a decision on whether to buy or sell. Okay. So there's one example. I'll give you another one in opposite direction, right? So same thing here. When you open a chart, the first thing you always want to ask yourself in terms of this technique is where is the market likely going? What pattern can I identify, right? The tip to identifying the pattern, ask yourself, is the market moving fast or moving slow? Right. So in this case, you can see, all right, up, down, up, down, up, down. It's really not going anywhere. It's kind of slow in its development. And then you look previously, the market from this high came down generally pretty fast, right? That's like an impulse move. So what you get here is a fast move down, a slow move correction. So again, it's a pattern that we all can recognize. Impulse correction. So when we identify this, then we know high probability, 70%, the market would likely continue lower, right? And when that happens, great. Okay, you can have what we call a bearish bias that you can focus in the trade. Okay, so again, it's not something very, very difficult. You just need a little bit of practice to understand what is impulse, what is correction. When you're able to identify this pattern, you will have that confidence in projecting the direction of the trade. Okay. Now that's the continuation pattern, right? Then we also have what we call a reversal pattern. Okay. So a reversal pattern over here is essentially giving us two types of signals. Number one, be careful, right? If the market is going to reverse, you might not want to aggressively take a trade in a particular direction anymore. And that also means that maybe if you're in a trade, you might want to consider taking profits. Okay. And number two, if you are a counter trend trader, this particular pattern is indicating to you, hey, take note, a potential trade is coming. Okay. So what is an impulse crawl pattern, right? So if you take a look at this here, initially the market moved up in a very, very fast move, right? Carrying a lot of momentum, a lot of energy. That's what we call an impulse move. Then as the market continues to go higher from here, you can see that it starts to struggle. Okay, it's going up slower and slower and slower. That is what we call a crawl pattern. Okay, so it's indicating to you, I'm struggling now, and there's a very good possibility 70% the market would U-turn. Okay, so what this means is that if today you see a pattern like that, at least number one, stop buying aggressively, right? It's telling you, hey, careful, the market may reverse, don't buy it anymore, right? Or it also tells you maybe you want to be taking profits if you've any buy trade. Okay. And number two, you can use this pattern to start looking for a counter trend, right? Which means at this point here, you can start to look, can I get a sell trade setup? Okay. So of course, if you flip that, it's the same thing on the right? The market came down very fast and then it starts to slow down as it continues to move lower. That's what we call a reversal pattern, right? It's an impulse crawl. 70% chance the market will go back up. Okay. Now let me show you how it looks like on the chart. Okay. So over here, you can see a little bit of a combination of continuation plus reversal, right? At the start, you have this very strong move to the upside. The market continue goes higher, but it's slowing down. What does it mean? This entire portion here, don't buy, right? It's already telling you the market is likely going to reverse. And then what happens? We have one impulsive move. And then the market pulls back correctively, right? So in this example, in this chart over here, you can see we have a crawl, the market reverse, we have a correction, the market continues. It's a very typical pattern that we see it repeat over and over again in the market. Okay. If I flip it in the opposite direction, you see the same thing, right? The market comes down, starts to slow down, and then of course the crawl develops. Be careful, don't sell it anymore. It reverses with an impulse, give us a correction, and then a continuation. Okay. So be practice and be able to identify these two very simple pattern, right? Crawl pattern and a correction pattern. And then whenever it appears on your chart, those are very clear indication of how you can actually project the next direction. I'll give you an example. If today you open up this chart and this is what you see, okay, the tip is very similar. Ask yourself, how is the market developing, right? So you can see that this entire chunk is very, very choppy, right? The market goes down, comes up, goes down, comes up. It's not it's not impulsive at all. It's coming down very slow. What was the market doing previously? From this high, it came down initially very strong, and then after that, slow down. So this is indicating to you a crawl pattern, right? When you see a crawl pattern, there's a very high probability the market would reverse, and that's what you want to be expecting. Okay, so in this case here, we expect the market to go back up, right? And that's what it does, right? So again, you realize that when you are able to identify this, there's really not so much of a guesswork anymore, right? We are basing on patterns that repeat itself and patterns that has high probability. Okay. Same thing here, right? Showing you variations of how it looks like. So this one, again, you ask yourself, how is price developing, right? You can see here it's very, very choppy, right? Up and down, but it's not fast. It's going up, but it's slow. And then previously here, this is where you have your momentum push, right? So this looks exactly like a crawl. What does a crawl pattern tells you? It's very, very likely it's going to reverse. Okay. And therefore, your bias when you see something like this is to be bearish bias. You want to be looking at sell trade opportunity. Okay. And that's what happens in the market. Okay. So once you are able to identify this two pattern, okay, trading and projecting your direction can be pretty straightforward. Okay. So let me just very quickly jump onto a chart. Okay. Let me just open up a blank chart. Okay. And show you very, very quickly on the application of it. Okay. Just give it a while as it's opening up the chart. Okay. I can pick anything, right? Today, if you want to look at, let's say, gold, okay, let's say this is on an hourly time frame, right? We open up this chart here, is the same process. You ask yourself, how is price developing, right? Obviously, this one here is a little bit tiny, not much of a data yet, but you can see that this leg here is very fast. Okay, the market essentially move up in an impulsive manner. Then the market ends here as of now, right? Do we have a pattern, right? We always ask ourselves these questions to guide ourselves in making the decision. How is the market moving? Do we have a clear pattern? Then you realize, hey, on this hourly time frame, all we have is just an impulse move. The market is currently here. There's nothing much else. There's no real clear pattern as of today. But let me help you visualize a little bit. Okay. Now, if the market tomorrow starts to do something like this, a slow corrective pullback. Now, if you get this, what do you have in front of you, right? We then have an impulse correction pattern. Now, what does this pattern suggest to you? There is a high probability the market will continue going higher. And that's where you want to be bullish bias, and then you anticipate the market would likely hit higher. Let's focus on the buy direction. Okay. Now, scenario two, if the next 1 or 2 days the market continue to climb higher but is slowing down, it starts to give you that crawl pattern. What do? You then know that, all right, this pattern seems to suggest that the market would likely reverse. You focus on the sell side direction. Okay. So sometimes when you open up a chart and all you see is just an impulse, you just need to be a little bit patient, give the market some time. Okay. You don't need to be trading every day if you're only looking at one instrument. But obviously, if you look at multiple instruments, that's where you have more opportunities available. Okay. I'll show you examples on this, right? So if you take a look at this particular pair, okay, okay, there's a gap here, but I just want you to visualize this gap is being filled, right? So you have like one strong push to the upside, and then the market does what? It does a very, very wavy kind of a pullback, right? Up, down, up, down, up, down. So it's a correction. Where do you think the direction would likely go next, right? It's likely going to go higher from here. Very simple projection, which means today, if I open a chart on pound yen and I would like to focus on a particular direction, I'll be bullish bias, right? Which means if today the market pulls back on pound yen, I'll be more interested to buy than sell. That's how I establish my directional bias, right? Now, once you establish the directional bias, then the next step is to decide where to buy. That's where the setup comes in, which I'm going to share with you in a while. Okay, but before you even jump into the setup phase, you need to first have a direction. You can follow the top process, right? Same thing here. If I open up, you know, let's just say on the slightly different time frame. Okay, pound odd. Okay, ask yourself the same question, right? How is price developing? So you realize that, hey, this one here is a little bit choppy. Okay, the market is basically going up, down, up, down, up. Not really going anywhere. It's a corrective development. Previously, price came down pretty fast, right? So what do we have over here? It's a combination of an impulse, potentially a correction. Now, if this continues to develop like that tomorrow, what do you think the direction on pound Australia is going to be? Pretty straightforward, right? We'll be looking at potential sell side bias. Okay. So that's what we mean by directional bias, based on very clean, simple, yet effective pattern recognition ability. Okay. Impulse correction, impulse crawl. Okay. Now, once you practice this, it becomes so easy that within that split second, obviously you are able to identify, do I have a pattern or do I not have? If you have a pattern, you can focus on it. If you don't have a pattern, you move on to the next instrument, right? Now, once you establish a pattern, okay, once you have a directional bias, that's where you go on to the next step, okay, which is your trade setup. right? So this is the part where your strategy comes in for you to decide, based on certain conditions that the market needs to meet. If it meets and check your conditions, that's where you have a trade. Okay, that's where you can actually execute a trade. Whether is it a pending order, is it a breakout order, or is it a market execution? This is where you take action, right? So to me, personally, I don't really do a market execution. All my trades are gonna be pending orders, right? Because that's my style of it. I like to wait for the market to pull back, tag my entry point, and then I'll set a pending order, and then that's how I get involved in the trade. Okay. So today I'm going to share with you the setup that I use based on what we call the SMC model, the smart money concept. Okay. And there are few things you want to identify using this, right? Of course, we already have the direction. Okay. So what we then need to do is we have a selected list of criteria that the market needs to fulfill in order for us to say, all right, this is a valid setup and therefore I can trade it. Okay, and then that's where we have like our entry, stop loss, and take profit. Okay, so let me show you the model. This is how the model looks like. Later, I'll show you in a live chart example as well, and of course, that also then covers what are some of the potential trades I'm looking into. So this is the model, right? So this model is pretty straightforward. What we want is that we want the market. Okay, so market structure break essentially is just telling you higher, 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 low, right? So this one usually we establish that on a higher time frame when we have a directional bias. And then what we do is we wait for the market to come into our demand zone, right? Which I'll share with you in a while, how to identify the order block as well as fair value gap, FVG. And then this is where we take our trade. I'm going to use FIBs, so I'm going to share with you all the details in a while. And then my stop is here, my target is here. Okay, so it's a very, very simple model. Okay, now obviously you need some practice, right? Right now it does look simple, but in a real chart example, it's not always so clean. Okay, the bearish market structure model is just the opposite of things, right? You just flip it. Okay, so let's introduce to you guys a little bit of a concept and principles within the SMC model first, and then we'll jump into the chart and show you each criteria. Okay. The first thing you need to understand is this thing called the fair value gap, or in short, we put it as FVG, right? So fair value gaps are often created when the market momentum is strong, right? So if you kind of understand what we meant by impulse wave, usually when the market forms impulse wave, um, there will be fair value gaps, right? So it's kind of like both of these principles can overlap one another. Okay, if you're trading equities or indices, fair value gaps are essentially price gaps as well, right? Gaps that you see on the chart, those are fair value gaps. But in terms of like if you're trading gold, CFD, FX, because of a 24 hours market, then we need to have a slightly different way to identify, what we meant by fair value gap, and we use a three candle pattern. Okay, we use a three candle pattern. So how does it look like, right? It's basically if today you have a very, very strong candle, okay, you have a very strong candle body, and then you start to realize that the previous left and the right candle did not overlap, right? The highs and lows did not touch one another. Then it forms an area where there is this, gap, right? And this gap literally calls fair value gap. Can follow? Okay. The opposite is true, right? So if you see a strong move to the downside with a huge bearish candle, then what you see on the left and the right candle, if they don't overlap, that's essentially your fair value gap here. Okay. Uh, so let me show you a little bit on the chart as we progress. Okay. So jumping a little bit back and forth here. Okay, but let me just zoom in and show you on the chart so it becomes very clear for everyone. Okay, now can you see that there's this huge bearish candle, okay, coming down? And then what you realize here is the left candle low and the right candle high did not overlap. Okay, so you have this candle low, this candle high, and then there isn't an overlap. This is what we call a fair value gap. Okay, so usually what I'll do to annotate the fair value gap is I'm going to take a triangle tool and kind of map it like that. Okay, then I'll zoom back out. We know, all right, this is where the fair value gap is. Okay, can follow that. Now, bear in mind, we don't trade or we don't kind of execute a trade just because there's a fair value gap, right? Fair value gap is just essentially one of the criterias, right? Which I'll share with you what are the criterias in a while, but fair value gap is one of it, right? So that's why I want you to understand what fair value gap is. Now, then there's also the principle of what we call order block. Okay, order block, whether you call it demand or supply or order block, it's the same principle. Okay, so what is an order block, right? So I'm showing you in the same example, same chart here, right? So you can see that as the market comes down, right? There's this little white candle here that indicate that it's a temporary pause when the market is coming down. Okay. So imagine the market comes down, comes down, comes down, and then over here there's a slight little pause, it goes a little bit sideways, and then the market continues lower. Okay. So this temporary pause is where we would identify the order block. Okay. So the definition of this is the last up move before the major sell side. Okay, because we're looking at the downtrend, right? We're looking at the down direction. The last up move before the down move, that forms your order block. Can follow, right? Let me show you examples where the market is coming up. Okay. So if you take a look at this here, the market went up, came down a little bit, formed this little pin bar here. That's where the market paused and then continue higher. Okay. So what this means is that this candle forms an order block. Okay. Now, order block and fair value gap serve kind of the same purpose. We don't just trade because there's a fair value gap. We don't just trade because there's an order block. We use this as part of our criteria. Okay, it's one of the criteria. It doesn't mean that if it's there, we execute a trade. It's just adding confluences to a trade. Good. So now let me walk you through the setup itself. Okay. First, criteria. So there are lists of criteria. I'm going to put it down, right? The first criteria is what we call liquidity sweep, aka sometimes we're just going to put LQ, which stands for liquidity sweep. Now, to put it in a very simple way of understanding what liquidity sweep is essentially what we call a fake break. Okay. What this means is that whether the market breaks to the top or breaks to the bottom, but then very, very quickly reverse. Okay. This is what we call a fake break. So again, give you an example as we progress on this. Can you see the market goes up, came down, went up again, breaking that high, but then very, very quickly reverses and U-turn entirely. Okay. So what this means is that this high here, when it's broken, is aka a fake break. Okay. And how we label that is we're going to put a line here and we put this as liquidity sweep, right? Usually in SMC model, we're just going to put like triple X to annotate that. So we know that, all right, previously there was this break to the upside, which, would kind of encourage breakout buy traders to get involved in the market, but then it traps them and very quickly reverses, right? So that's where the fake break comes in, and that's where the term liquidity sweep comes in, right? Kind of fake the traders to go in and buy, but then after that reverses and trap them in. So that's what we call liquidity sweep, right? Now, from there, what is the second criteria? We also want to see a market structure shift, okay? Or sometimes you would see terms like break of structure, BOS, right? So market structure shift, MSS, or break of structure, BOS. Now, what is this, right? It's essentially telling you, look at structure, okay? You have up, down, up, right? In this case, all this is up structure, bullish structure, until the market came down and take out this swing low, okay? So usually liquidity sweep and BOS kind of tend to come together because we have a break of structure. Therefore, let's conclude that this is a fake break, right? So how do we label it? Okay, we take a line chart and often I'm just going to put BOS, right? Break of structure. So these elements here are important, right? So you have like a checklist. The more the setup, check it out, the higher the probability, the confidence of this particular setup. Okay. Then what we also want is we want to have fair value gap or an order block. Okay. So we just went through the principle of fair value gap and order block, right? So what we want is as the market comes down and break the structure, we want to ensure that this move that breaks the structure is an impulse move. And how do we define that is when we see that, oh, there is a fair value gap created, okay, or a little bit of an order block here. That's where we know, all right, this down move is strong, it's impulsive because it leaves behind fair value gap. Okay. Now, the fourth condition here we want to see is what we call an internal liquidity. Okay, now what is an internal liquidity? As of now, we don't really have it. But if let's say the market goes up, comes back down, it forms this internal high, and then when it goes back up, this is what we call an internal liquidity. Now, this is also internal liquidity, but this one here is pretty far from the key area of a fair value gap, right? So this one here is not too important. But as I draw out here, if this forms a internal high, comes back down, then starts going back up towards the key level, this is what we call an internal liquidity, right? So think of it as similar principle of liquidity sweep. If we have an internal liquidity here and the market goes up and comes down, it traps traders again, right? That would then increase the odds of our trade. Okay, so that's one element to consider, internal liquidity. Okay, then finally, what we have is FIB retracement. Okay, so to me, I use a lot of Fibonacci retracement. So how do we do it? We take our swing high, pull it to swing low. The FIBs I'm looking at is 67% retracement, right? So what I mean by this criteria here is I want this FIB retracement to come in very, very close confluences with either my fair value gap or my order block, right? So in this example, we can see as of now, we do have that, right? Okay. So if I kind of look at this checklist around, right, what do we have? We have liquidity sweep, check. We have market structure shift, check. We have fair value gap, check. Do we have internal liquidity as of now? No. Okay. Do we have FIB retracement confluences? Yes, check. Right. So out of 5 conditions right now, what do I have? I have 4 out of 5. To me, that's pretty okay. I don't need a perfect setup, right? But this is something that I'm willing to take a risk on because I know, okay, 4 out of 5 conditions are met. The probability is there. I'm okay to take the trade. Okay, so how do we look at our entry, stops, and target? We'll put our entry as a pending sell at the 67. Our stop loss is going to go above that swing high, which is basically the 100%. And our take profit is going to be first the previous swing low. Now, this risk to reward ratio will always give you an average of 1:2, which means if today you're going to risk 1R, let's say 1%, you're going to make back 2R, which is 2%. This is very important because if you have a healthy 1:2 risk to reward ratio, your win rate at a 55 to maybe 65% win rate, you're going to be very, very profitable on that. Okay, and that's what we're focusing on, right? We're not focusing on like 90% win rate or 100% win rate. it's very hard to achieve that, right? So what we are achieving here, what we are targeting is right, a very, very achievable win rate, about 55 to 65%. Even let's say let's put it as 60% win rate on average. If you have a 1:2 risk to reward ratio, it's a very, very profitable outcome. Okay. Now obviously this is the setup, right? But let me just backtrack a little bit and go back onto the higher time frame. Now, if you look at this on a higher time frame, how do we establish the bias on looking at the sell, right? Like, why am I bringing the pound odd out? Okay, because we have this huge move down, and then the market recently has pulled back. Now, obviously, if you have experience in technical analysis, you can include in some simple things like great previous support, now turn resistance, confluences, very nice little reaction. So moving forward, I have a bearish bias, right? I expect the market to continue move lower. That's where then I go back to the lower time frame and say, hey, now I want to focus on the sell. Do I have a sell setup? Okay, so from direction, I go into the setup phase. Now, once I establish all this, how do I apply the context, right? So then obviously I need to understand, okay, if I'm going to trade pound Australia, is there any high impact news I need to take note of that might, cause the market to be very, very volatile? If is, maybe I might want to reduce my risk. Maybe I want to wait for the news to be out first before I take a trade. Okay. Context on multi time frame analysis, right? We're looking at the sell. Higher time frame is also on the bearish bias, so I'm looking to trade it in line with the overarching trend. Maybe as part of a management, I don't need to have my full take profit here. I can go for a second target, right? I can go for more because I'm trading in line with the higher time frame. Okay, so that's how you can see the application of the DSC framework, right? From setting the directional bias to the setup here, right? With all these conditions that I'm looking at, and then applying the context itself. Okay. So if I share with you what I'm looking at this week, right? Really in terms of the application of this. Right now, obviously, GBP AUD is one of the trade setup to look into. Okay, let me just bring this in. GBP AUD is definitely one of the setup that you can look into, right? Which I can't cover just now, right? We're looking at if price pulls back, our entry is somewhere between 2.2060, and our stops is above, target is below. Another setup that I'm looking at is the pound yen, right? Now, why pound yen is because if I bring you to the forward time frame, as I highlighted just now, right? We have a clear bullish bias on pound yen, right? Impulse correction, market starts to push higher. If it comes down correctively, we have a buy bias, bullish bias. And then, of course, on the lower time frame, we have a setup over here. Okay. Now, I was also looking at Euro Australia, Euro dollar buy, but of course, this continued to push higher. So probably this needs to be updated a little bit, which means that, probably the setup won't come in so soon. We'll need to see how price develop. Okay, but the closest to setup that for you guys who are interested to keep track and keep watch, GBP JPY will be one, and the other one is Pound Australia. Okay, so this two have pound in it as well. So obviously you need to factor in your risk exposure in terms of like market correlation. Okay, so yeah, that's basically what the DSC framework is, right? And of course, showing you the application of the framework, how we use direction to project, okay, as well as the setup that I personally use to execute trades, and then the application of context in terms of like multi-time frame. Okay, so hopefully so far so good. Now let's very very quickly open up the Q&A segment, okay, and see if you guys have any question, right? So if you have any questions on what we've covered so far today, do feel free to put it into the chat, okay, so that I can then take a look at your questions and hopefully answer as many questions as we can. Okay. Understand that YouTube here might have a little bit of a slight delay, right, on the stream itself. So I'll give it a little bit of time for you guys to also type in your questions, right? Okay. Any questions that you have, just put it into chat. Yeah. All good. Okay. So if no question, very, very quickly, what I'll do over here is to just put this. Give me a while. Okay, let me just put this back up. Yeah. So just want to reshare this again in case some of you join in slightly late. We do have KVB right now have this switch bonus reward and promotion. Hey, so of course, for those of you who are interested to find out a bit more, do check out on the link that was put up in the chat. Okay, once you click into that, you can go and register for your own account. Once you've done all those, you can come into the reward segment on the left. You can see over here. Okay, and then under that, you can see the switch bonus, which is very, very interesting. So it's actually ongoing until the end of the year. Okay, you can actually then click into participate and find out all the details. But in short, basically, if you would like to try out KVB, you have previous other accounts on different platforms. They have this kind of promotion reward that if you switch over and you make a deposit, okay, so you can see over here, make a deposit, accumulative deposit of $500 or more within 14 days. You can actually receive up to 1%, right, of the switch deposit bonus at a cap at 2000. Okay, of course, there are also the cashback bonus, right? So again, you can find out more details once you register your account and log in into this. Okay. Very, very quickly over here, let me also bring give me a while. Let me bring up the other information here for you. Give me a while, yeah. Just want to bring this out. Okay. Um this one. Okay. So next, as I mentioned earlier as well, right at the start of the session, we do have a series of webinars for the month of November. Right. So today we cover a little bit more on the kind of like quote unquote theory aspect of the framework, right? DSC. But next week here we'll be diving straight into the markets. Now today we did go through a little bit, but it's just very, very selected because of time. But next week we'll dive straight into the live market analysis, okay, where we'll go through Number one, all the instruments in my portfolio itself, in the watch list itself. And of course, it's a really good opportunity for you guys to also, ask questions regards to trading, or if you have any instruments that you're trading, you'd like to have a different perspective or insights or analysis of that. Next week's session will be a great one to do that. Okay. And of course, feel free to invite your friends to join in as well, because these sessions are all opened and available for you guys. Of course, again, thanks to KVB for hosting, okay, and kind of like conducting this live streams for fellow traders like yourself, okay. So, yep, that's all that I have for today's session. Hey, I hope you guys enjoy and pick up something from today's sharing. And of course, all the best to your trading for this week. And I look forward to seeing you guys next session on the 18th of November. Okay. So see you guys. Good night.